Hello, I'm Donald Leggett, and welcome to the latest London South East CEO interview. I'm joined by Will Rhind, founder and CEO of US ETF provider GraniteShares, who have assets under management of $1.5 billion. In the UK, Granite specialise in long and short ETPs. Welcome, Will. You're joining us from New York today, a long way from your Aberdonian roots.
Thank you, Donald. Great to be with you. Thank you.
And Granite, I'm presuming, is a reference to the Granite City, which is what Aberdeen is better known as in Scotland.
Yeah, it absolutely is. Yes, it's where I'm from, where I grew up. Been living in New York now 11 years, but Aberdeen's still home for me.
So what took you to New York, and why did you launch an ETF business there?
Well, I started off my career in London. So I was in the asset management business in the UK. Originally, actually, with Barclays Global Investors, which obviously now is BlackRock. But we were involved with the ETF industry really at the dawn of its creation in Europe. So I was some right place at right time working with ETFs at the beginning of the industry, and really had followed this product throughout my career. And I ended up going to New York for a job, and I started up a business in New York and ran that for a number of years. And ultimately just end up staying. And that was 11 years ago. So here I am still in New York, but now my own business, Granite Shares. And obviously now we have an operation in the UK.
So ETFs are a huge product, big time product for investors. Why should experienced investors use ETFs rather than invest directly in stocks?
Well, like you say, Donald, I mean, now the ETF industry has grown to be $6 trillion roughly around the world. And it's become, from humble beginnings to, probably one of the most utilized products in the asset management industry, and really offers a few key benefits for people. I think the first thing is, just like any consumer would be familiar with, is just choice, that you have the option to invest in practically anything you want, from big, broad country benchmarks to fixed income or bond indices to commodities. And then obviously you have the ability to have leverage as well. And so they're very, very popular. They're low cost. That's another thing that attracts people. So typically ETFs are much lower cost than traditional mutual funds, and also can be efficient from a trading and a liquidity perspective. In other words, you can buy and sell them whenever you want, pretty much on market hours, which is very appealing to people, the flexibility.
So would you say that everyone should have an ETF as part of their pension portfolio?
Well, I think if you want to invest in funds, then absolutely. So ETFs are not a replacement for stocks. They can be a complement, but they are different investment animals. But the reason why they're so popular is because they give you diversified exposure to the fund industry in a very, very low cost efficient way.
Talking of which, in the UK, you're going to step further and innovated. Well, the FT said some very kind things about you a month ago, so it must be true. You've launched ETPs for 9 individual US tech stocks and a handful of large cap UK ones. So talk me through at a very basic level how those ETPs work.
Yeah, so Donald, what we've done is really invented a new category for the exchange traded product industry. And, as I was talking about, you can get exchange traded products on almost everything, and including leverage to individual things such as commodities or broad benchmarks. What we decided to do is really expand that category by offering leverage on individual companies themselves. And so what we offer is 40 products in the UK. That's 3 times leverage, both long and a comparison short, to some of the most popular traded companies in the UK on the FTSE 100 and in the US in the tech mega cap space. It's a totally new concept for people, but it really expands the exchange traded product category for the active investor into a new realm that they haven't seen before.
So tell me the new economy and the old economy stocks that you can invest in. And
yeah,
and round up the advantages for a UK investor in using your ETPs.
Yeah, in the UK, in terms of some of the old economy stocks, we have traditional stalwarts of the UK market, such as the oil majors, BP and Shell, the banks, Barclays, Lloyds, some of the industrials, BAE Systems, Rolls-Royce, also popular stocks, and then we have mining such as Rio. So what we tried to do in the UK is take the most popular stocks, but also add in a bit of sector diversification as well, so you can get exposure to multiple companies that are popular, but also in other sectors if you wanted to play one sector against each other. And so that's sort of the representative of the more traditional UK market. And then you have the US tech mega cap names, anything from your FANG stocks, your Apples, your Amazons, to your Teslas, Facebooks, etc.
And those have the US tech stocks in particular have had a phenomenal bull run. Have you been noticing that reflected in your sales of your products?
Yeah, I mean, the story really is that these stocks, for those of you that are familiar, have really contributed the vast majority of performance to the major US benchmark indices. And now the 5 major US tech firms really account for all the performance in the stock market, or at least the vast majority of the stock market performance. And that's been a huge mega trend for people to get behind. And so I think with COVID-19 especially, it's really just accelerated that trend even further and really brought forward probably 10 years worth of tech disruption into the last few months.
Now, I wonder how much of a seller the 3 times leverage has been. Let me ask you, does that mean you can lose 3 times the capital you invest? Or tell me, because that's slightly scary for me.
That's a really good point, Donald. No, so 3 times leverage means you get 3 times the exposure or 3 times the daily movement of whatever the underlying stock is. So if you're invested in 3 times Amazon, for example, and it goes up 2% in a day, then the 3 times long Amazon will give you 6% return for that particular day. So what it means is if you get that wrong or if it goes against you, you can only lose a maximum of the amount that you actually invest. So you can't lose 3 times your money. And that's a really important thing for investors to understand. But furthermore, there's actually an inbuilt stop loss mechanism in it, Donald, so that we don't want people to even lose all of their money in it. And so if there's an underlying movement in the underlying index, above a certain tolerance level, a stop loss will kick in. And that helps to mitigate some of the losses if you're in the unfortunate position where the underlying goes against you.
I'm sure people could be very grateful for that in certain dire moments in their trading lives.
Yeah, well, we've had experience, obviously, with previous companies of these products before, and I think one flaw, in the design was that some of the first generations of these types of products didn't have that feature built in, and so it's not uncommon for some of the more volatile investments to move more than a third, for example, if you're 3 times leveraged in a day. And so from that perspective, we thought a valid improvement to that model was to build in a stop loss to stop those kind of things happening.
Now, it's probably a good moment to talk about Tesla as a case study. It's one of the most talked about stocks on the planet. It's one of the most shorted stocks on the planet. Put the numbers into Tesla. I know that Tesla recently went down 21% in a day. So why would that have benefited me to hold it in a Granite ETP rather than hold the stock directly?
Well, Tesla's a great example because it's been really one of the most polarizing stocks in the market. As you rightly point out, some of the most famous hedge fund managers, investors in the world have taken short positions against Tesla. And put simply, that's something that a professional hedge fund manager is able to do because they have the tools available to do that. But it's not something that regular sophisticated investors can do because they don't have the ability to go short easily on a stock like Tesla or any stock for that matter. So it's a vital risk management tool to enable people to not just go long on an underlying stock, but also to short if they think that the value of that stock is going to fall in a given period of time. And so Tesla, the 3 times short, Granite Shares Tesla in our case, or the 3 times long, gives people the ability to express their view, be it positive or negative, on a stock like Tesla. And I think the most important thing is, irrespective of what the future holds for Tesla, it's a very volatile stock, meaning that for short-term investors, there's opportunities for both the short side and the long side. And our ETP just gives those active investors an ability and a mechanism to trade that.
So would people be buying them to hedge risk as well? Is that a use of your ETPs?
Well, the beauty of ETPs is you can use them for all types of trading and investment scenarios. So there's not a one-size-fits-all, because at the end of the day, it's just an instrument that's listed and traded on the stock exchange. So there will be some people that will hold them intraday. They will buy and sell intraday. Maybe before, given that this is obviously trading in UK hours, before the US market opens, some people will be buying and selling, in anticipation of that. Some people will be holding for longer periods. Some people will be hedging risk. I mean, their investments, obviously, the Scottish Mortgage Investment Trust is a very popular holding for UK investors, which has a large percentage of its portfolio in Tesla. And so there is no way for investors to hedge against that if they think that the short-term direction of Tesla is negative. So it's one application of it. But the beauty of it is, from the long and the short side, just like any ETF, there's the ability to use the product for all types of trading scenarios.
And is it less risky than spread betting? And well, I know that one of the benefits is it can be done in your own trading platform, but is it less risky than spread betting in general?
I think the answer is yes, Donald. And the reason for that is that you have a controlled level of risk. So in other words, it's a constant level of leverage, 3 times leverage, both on the long and the short side. You can't lose more than the initial investment you put in, which is a key difference. And one of the other things that makes it different is there's no margin attached to it. In other words, you don't have a margin account or a margin position to manage, which can also be difficult for investors to do that. And that can contribute negatively to their performance. So I think there's 2 things that are big benefits for the ETFs. Also, you can buy and sell them with any broker you want. They're just an exchange-traded product at the end of the day. So there's multiple market makers and liquidity involved, which is also important.
It sounds like you've been trying to design a product which offers some risk exposure for investors, for experienced investors, but not too much.
That's right, Donald. I mean, this is not for everybody. This is a 3 times leverage.
Not for widows and orphans.
Exactly, on individual stocks. So what we're trying to do is, give the active investor more tools in their toolbox to enable to, tackle the market volatility that we're seeing. And we believe that that market volatility will persist, particularly through these, trying times in the pandemic. And so really it's giving investors an additional way to manage their money. And it also just flowing into the broader fintech theme of investors being empowered to manage more money themselves, instead of just, gone are the days of just outsourcing it to some fund management firm and sitting back and waiting while they charge huge fees, and you have very little transparency into how that's going. The internet has really created this environment where people have more information than they've ever had access to in their lives about financial markets and financial education, and further, the product set and tools available for them to invest have never been better. And so that cocktail is really creating this drive for more DIY investment solutions, if you will, that enable your active investor to manage their own hedge fund, if you will.
Our experienced investors on the London Southeast platform will be nodding their heads enthusiastically at all this, I think, Will. We've got 8,000 people on the platform at any one time now, up from 5,000 before the COVID stroke market crash. So I think they might be very keen on this. How do you actually get hold of a Granite Share ETP?
Well, you buy it through your broker. So it's just like any other ETF, whereby it's listed on the stock market. In our case, it's the London Stock Exchange. So the majority of brokers will give access. But if your broker does not give access, obviously, contact them and make sure that the Granite Shares ETF offering is available. However, certainly some of the larger brokers in the market, such as IG, for example, offer the products, and the client base has been pretty active in terms of trading the ETPs. And
the website address is?
It's GraniteShares.com, just as it sounds, granite like the rock, shares.com. So please contact us for further information. Hopefully you'll find some good information already on the site, but of course, any questions about the product, please reach out to us directly.
Will Rhind, thank you very much indeed for speaking to us from New York today. It's absolutely fascinating. If you're interested in these Granite Share ETPs, you'll find the website address on the screen shortly. My final thought, thank you for joining us. And please, in these dangerous times, do stay safe.